So guess what? Inflation, which has been sky high and pretty much given everybody a headache for the last 40 years, it's finally starting to cool off at a pretty fast pace. That's like a breath of fresh air, right? But is it really though? Check this out.
The market's up, rates are down, and there's CPI. There's also claims, Sarat. What do you think?
Look, I think this was expected, but I think the biggest question is what's the Fed going to do with this? People are still expecting rates to go up. I think they might sit for a little bit, but the data is coming in to show that, look, inflation coming down, but it's still embedded in our system. And being embedded in our system means that I don't see rates in the next year or so going down, which part of the market thinks is going to happen. So I think as an equity investor, one needs to be really careful here and not chase some of these rallies, especially for stocks that are looking for, lower discount rates.
So yeah, they didn't exactly sound all that celebratory. What do you guys think? I definitely know a lot of folks here in the United States who've been pretty much feeling the pinch in our wallets from higher prices on everything from groceries to finding a place to live. Some of my friends say it's just a never-ending cycle of disappointment. It never gets any better. Prices go up, but salaries, they stay low like always. Bottom line, this is not the American dream that everybody thinks. Hit the like button if you guys agree. The Labor Department just dropped some serious numbers. Turns out that the Consumer Price Index, which measures inflation, went up by only 3% annually in June. And it's the slowest rise since March of 2021. But I don't know, guys. I'm still not feeling too certain about this. You see, this isn't just some numbers game. This actually has a major impact on decisions that are made by the Fed and all those other big shots who actually run the financial show, decisions that can ripple down to us working class Americans. I mean, think about home buyers trying to get a deal or seniors trying to make ends meet. These new inflationary figures, they're definitely something policymakers are going to be using to make calls that could mess with our budgets later on this year. The Federal Reserve, the guys who basically control the interest rates, they're keeping a very close eye on the Consumer Price Index. And they're also looking at another measure, the Personal Consumption Expenditures Price Index, which usually shows lower numbers than the CPI. But here's the real kicker, guys. Even though both of these indices are showing inflation slowing down, it's still running hotter than the Federal Reserve's ideal target of the 2% that they're trying to hit. And so especially their core inflation, which takes out the price swings of food and fuel. Last month, core inflation shot up by a whopping 4.8%, more than double what the Fed wants. Experts at Fitch Ratings say that even though things are getting better, we're still looking at core inflation sitting around 5% when you look at the big picture. And that's way too high for comfort. They say the job market looks good, but the way I see it, they're adding more part-time jobs while losing the full-time jobs. Inflation data may be low, but they don't expect the Fed to declare mission accomplished yet. History has shown that inflation is stubborn and can last longer than expected when it becomes elevated and entrenched. And the current round is still making an impact on consumers. I mean, the CPI has risen nearly 19% since bottoming in April 2020 during the early days of the C-19 pandemic. Now, as experts pointed out, we could feel pretty confident that inflation is moving in the right direction, but we really shouldn't be overly confident. So, for example, housing-related costs, which make up about a third of the inflationary index weighing, are dropping. They're also showing signs that wage gains are slowing down. Then there's the employment cost index, which tracks the changes in the cost of labor for employers, encompassing wages, salaries, and benefits over time. Now, this is another very key inflationary measure, and it showed a 4.6% increase in the second quarter, which is down from an all-time peak of 5.7 from the previous period in 2022. Now, much of the inflationary surge that began in 2021 was caused by clogged up supply chains. Y'all remember that? Ports, factories, and freight yards, they were overwhelmed by the explosive economic rebound from the pandemic recession of 2020. The result was delays, parts shortages, and higher prices. But supply chain backlogs have eased in the past year, sharply reducing upward pressure on goods prices. Prices of long-lasting manufactured goods actually dipped in June, but there are still danger signs. Health insurance costs, for instance, they're expected to start climbing now that a statistical adjustment for the Bureau of Labor Statistics uses expires. And that adjustment has caused the health insurance component of the CPI to show a 24.9% slide over the past year that now should reverse. Also, Gas prices have soared this summer as the cost of U.S. crude jumped nearly 16% in July. A gallon of regular unleaded gas now costs $3.82 a gallon on the national average, which is actually up more than 8% or close to 30 cents a gallon from the same time in July, according to AAA. They're also facing a daunting problem here: inflationary pressures in service businesses, restaurants, hotels, entertainment venues, and the like, where wages represent a substantial share of the costs. Worker shortages have led many of these service companies to sharply raise pay. Just recently, for example, the Labor Department reported that the average hourly wage rose 4.4% in July from a year earlier, more than expected. Now, to cover their high labor costs, companies have typically raised their prices, thereby fueling inflation. It's kind of like a short-term win for the employees, but then prices catch up and then you're back to square one. These are all going to be factors that the Fed's going to be considering in their next possible rate hike meeting next month. But they're saying that the bar for lowering rates, though, it's high because inflation is not benign and still above their target. They'll probably wait until they're absolutely sure that inflation is going to be getting back down to the target before they actually consider cutting rates. Whichever way this goes, I definitely recommend subscribing to the channel and make sure you guys hit that notification bell. It looks like some pretty big developments are in the pipeline. You don't want to miss any of those updates, so make sure you guys subscribe and drop a like for the video. Appreciate that. But sure, inflation is coming down, but it may not be falling fast enough to satisfy the Federal Reserve. Some economists are forecasting that the central bank will boost interest rates by another 1/4 percentage point at the next meeting. Now, if the Fed raises rates again, consumers could face even higher borrowing costs. Credit card APRs already at a historic high, and mortgage rates could continue to rise if the Fed boosts rates because these types of debts, they tend to move in tandem with the underlying Fed funds rate. Now, for our Social Security fam, SSI, SSDI, will this impact your Social Security benefits? Well, yes, because Social Security benefits are adjusted annually for inflation. And the Social Security Administration, the SSA, they're basing its cost of living adjustment, the COLA, on the inflation data from July, from August, and from September. Meanwhile, you got CPI data for the last 3 months, or for those 3 months, it's not available yet. And some forecasters are already projecting their estimates for the 2024 COLA based on inflationary trends so far this year. Now, with prices cooling, they're predicting that the nation's seniors will see a much smaller boost next year. Now, according to the Senior Citizens League, the COLA could be 3% next year. Another group, that's the think tank Committee for Responsible Federal Budget, and it says Social Security beneficiaries will receive a COLA of 2.6 to 3.3%, depending upon where inflation falls after next month. Now, a few products and services are still seeing relatively high price increases. So you got housing inflation remaining, a pretty major concern for a lot of Americans, and it's one of the largest contributors to the rise in prices. But economists, they expect the housing prices will begin to dip later in the year, helped by new construction. Rents have been coming down in certain places where new rental construction has been coming online. More supply, even with steady or rising demand, lowers costs. Prices are falling in a lot of these major spending categories. Energy costs, they saw the biggest drop. Gasoline is about 27% cheaper than it was a year earlier, according to the labor data shows. Used car prices, they're also lower with a 5.2% dip last month. Meanwhile, you got airline fares, they've plunged about 19%. Now, on the grocery front, some items are actually pulling back from their pandemic price gains. Eggs dropped almost 8%. This is after their ridiculous surge in egg prices earlier this year that pretty much stunned some consumers and prompted a lot of people to raise their own backyard chickens. You guys remember that, right? People were raising their own chickens in their backyard and everything. Other grocery items with price cuts include pork, bacon, and butter. Now, the hope is that this slowdown in inflation will buy investors time and give them the opportunity to catch their breath. By the way, if you own a home, make sure your home is protected. Get your free home warranty quote. There is a link in the description down below this video. Now, a lot of the critics and the hawks, though, they're not exactly sold on the idea that the current Fed rate hiking spree, which kicked off in March of 2022 and has seen 11 increases totaling 5.25 percentage points, should come to a screeching halt just yet. Now, the key word for them, vigilance, as the Fed would basically maintain their vigilance against inflation, all while refraining from prematurely patting themselves on the back with a mission accomplished. Y'all know what I mean, right? Now, on the macro scale, These rate hikes, they seem to have pretty much jived very well with the economy. After a slump in the first half of 2022, GDP has managed to stay positive in territory, and it's showing a 4.1% annualized rate in the third quarter. But let's not forget that despite the seemingly rosy numbers, regular folks in the United States are not exactly giving the economy a standing ovation. President Joe Biden's approval rating is still laying very low at 39%. And a major reason behind this could be the pinch of high inflation and rate hikes that's really being felt in our everyday lives. And it's hitting small businesses pretty hard and adding weight to household debt burdens, especially the small business sector. They're really feeling the heat as credit card interest rates are outpacing the central bank's key interest rate. And this is far from good news for businesses that rely very heavily on credit for their growth and for innovative ventures. I mean, it's just a matter of fact, like when rates rise, so do the number of businesses struggling to keep up with their loan repayments. And this situation could put a major dent in the small business landscape, potentially forcing some to close up shop, default on loans, bankruptcy, you name it. Now, looking at the brighter side, if the data does keep cooperating, the Fed actually might consider easing off the throttle of their monetary policy moves. At least that's what some experts are starting to voice out. Now, whether the Fed indeed does decide to stop will depend on data points like the CPI reading that we talked about earlier. Breaking down the report and the state of inflation could end up being more about the details than what the headline numbers say. The shelter and healthcare components will be closely watched, as will energy and food as always. Trends in things such as core services also will get attention, as will more granular items like appliances. So for example, Bank of America noted that real-time data is showing that retailers are cutting prices across categories for large appliances. The bank's gauge of prices for the category is down 5% so far this year, possibly pointing to a broader trend of softening inflation. Markets, though, they're still a little nervous. A bond market measure of inflation pricing known as a forward rate, it's pointing to a one-year rate of 4.83% after falling below 4% in May. And for businesses and consumers, that could be trouble. Credit card debt in the second quarter surpassed $1 trillion for the first time. And some industry insiders expect small business debt default rates to escalate as interest rates stay high. They call it a pipeline full of growing delinquencies that's showing no abatement. By the way, if you guys made it this far on the video, drop a like for the video. Also subscribe to the channel. Check out my previous videos, and I'm gonna catch you guys on the next one.